Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Well, hello, everyone. Welcome to the Millionaire Next Door podcast. We're so delighted you're here today. Received word we've had north of 29,000 views or listens. We're heard in about 112 countries. So wherever you're joining us from, again, welcome. Thanks for spending some time with us. Today is actually just I'm going to call out the date. It's September 20th of 2024. So we're going to get into some market dynamics and things that are happening with financial markets and globally. And to do that, I've got a guest I'm really excited about. This is Miles Clark. He's a research analyst with Nasdaq Dorsey Wright. We've had one of his colleagues, Will Gibson, on several times talking about how a lot of the work they do is kind of integral in our process and how we, very seminal with respect to our objective unemotional rules-based process. So at any rate, welcome, Miles. How are you?
Great. Yeah, appreciate the introduction. I'm really looking forward to it. You and I are talking at a pretty good time. It's been a pretty busy couple weeks for the markets. Of course, with rate cuts, I think we'll chat about that a little bit later. And of course, in the next couple weeks, we're going to be talking about the election. So there's plenty of stuff going on. I appreciate the introduction. I'm really looking forward to today.
Yeah. So we've been observing and commenting for quite some time. Markets seem fairly calm and low volatility, but for several months, we've been observing a lot of rotation and movement under the surface. And of course, there's a U.S. election coming up. That's getting a lot of coverage on a lot of people's minds. Interest rates, just to put it in context for folks, there was a giant interest rate cycle increase starting March of 2020, correct? I think maybe 11 or 12 rate increases. They just lowered the rate for the first time 50 basis points or 0.5% on Wednesday of this week. So that's the backdrop we're referring to. But yeah, go ahead. I'd love to hear some of your thoughts and comments at this time.
Sure. I guess we can start off super base, just introduce myself and kind of run through what I do with Dorsey. So as you mentioned, Will, my good friend and colleague, he's been on before and has talked about who Dorsey Wright is and what we do. But just for those of you who aren't familiar, this might be your first time listening. Dorsey Wright is a technical research-based shop out of Richmond, Virginia. And so technical analysis is a very broad sweep of things or ways to look at markets. But Dorsey Wright specializes in point and figure charting, which was kind of modernized and adapted by Dorsey Wright in the late 1980s. But of course, it's been around for much longer than that. So, we'll take a look at markets from that, and it's all based on relative strength and, finding assets that are relatively stronger or weaker than others to kind of hone in our investment process. I'm one of the analysts with the team, and I've been on for about 2.5 years or so. I started up right outside of Washington, D.C. as just a student of the markets. I remember I got interested in kind of learning how everything works when my dad and I were going through, and I employed kind of a buy what you know type of analysis. So younger Miles liked Disney. He liked Nikes that he wore on the soccer field each weekend. I kind of wish I could go back and tell Miles to like NVIDIA and Bitcoin. But unfortunately, I'm not a time traveler. But yeah, from there, that kind of got my interest spurred and then went down to Christopher Newport University for 4 years of undergraduate. You wouldn't know Christopher Newport. There's only reason that's really there is a shipyard in Newport News. And then it was just a super easy hop, skip, and a jump over to Richmond, about 2 hours west. And I've been on full time for about 3 years. So that's kind of my life story in a sentence.
That's great. Well, when you made reference to Nikes or that, I mean, the old Peter Lynch, right, from Fidelity used to say, sort of buy what you know and what you own. So it is interesting, when you're walking by a Chipotle or whatnot. But yeah, I've been using Dorsey Wright for probably 15 years, and it's been an amazing process that they have going on. So at any rate, I use it a lot. I integrate it with client discussions. I explain it to them. Some folks understand it, some don't really know. They just want to know that I have a process, a very disciplined, rules-based process. But back to you. Keep going on. That was a great introduction. Yeah.
Yeah, no, I appreciate that. I think before we jump into the rate commentary, I've got one thing that I'll typically talk about with clients that hopefully makes relative strength a little bit more easy to understand, right? Because it can be a little bit daunting to go and say, oh yeah, we've got this relative strength process in our investing sleeve, whatever that is. And their eyes kind of glaze over and they're like, huh? Yeah, okay, sure,
Yeah.
right. I'll do whatever. But, when you start to think about it, we actually use relative strength in every day in our lives, right? I don't know, Robert, if you're a fan of football, are you by chance?
Yeah, I'm a fan of football, mostly college football, a little bit more than pros because I live in Los Angeles and the Rams
Yeah.
moved years ago, and but at any rate, yeah, go ahead.
Well, you've got
I know
a
where you're
couple
going with
teams
this.
out there.
Yeah.
So, if you're creating a fantasy football, I'm very big into football, by the way. My Saints, New Orleans Saints, at the time of this recording, they are absolutely on fire. Let's hope by the time you're listening to it that stays the same. But if you were creating a fantasy football team, you would probably want to fill your roster with the Patrick Mahomes and the Travis Kelce's and those guys, rather than the Daniel Jones, right? So we use relative strength every single day, every single week, just outside of investing. And so when you can kind of parlay that over into your investing philosophy, it starts to get a little bit more clear. So that's hopefully a little bit more of a translation on why and how relative strength works. Of course, the investment processes on top of that can get as complicated as you like, but that's kind of the skinny.
That makes a ton of sense. I know you mentioned Mahomes. I just remember watching. I'm not a huge football fan. When I watched the Super Bowl last year and Mahomes came in, I just knew what an incredible athlete and dynamic he was, and I said that's a pretty killer advantage for that one team. So
exactly,
maybe he's the NVIDIA of it's.
Right.
It's powerful. It's powerful.
Yeah, exactly. And then, of course, if you got the other side and you've got a drag on your team, right? You're never going to the Super Bowl, right? So if you've got a drag in your portfolio, it's best to kind of pull the weeds there and let those other stronger names kind of shine. But anyways, I digress. We can kind of talk about the rate cuts. I think would probably be the best place to start. I know that my friends have all texted me, people I haven't talked to in years. They know that I'm a finance guy now, and because I was back in school, and they're like, Miles, so how you doing, man? So there's rate cuts. Is that good? Is that bad? Like what's going on? I think everybody knows that rate cuts are important, right? But I don't think everybody knows really why or what impact that might have on our portfolios. Would you agree?
Yeah, we don't really know. Might be able to look at the past different, but keep going. Yeah.
So the idea is that everybody kind of really has this idea that, oh, rate cuts are big. It's kind of a big headline. Like, what does that mean for markets? And of course, everything is going to be pretty dependent on the exact picture that we're looking at. So the economic cycle, the economic strength. We've seen rate cuts, will typically come as a kind of an economic stimulus to the economy, like a shot in the arm, kind of that. And the reason for that is because it makes borrowing money a little bit cheaper to do so, right? You think about making credit card payments each month. If your interest rate's lower on that, you're going to be able to maybe stomach a little bit more than you could if interest rates were higher, right? And so rates coming down is typically used to kind of juice up the economy. But of course, what is the actual practical following of rate cuts, if you will? So you take a look at a couple of different asset classes that you might be interested in. You've got, for instance, the fixed income is probably the best place to start. Fixed income makes a little bit of sense, right? Fixed income typically appreciates. You look at some benchmarks for fixed income. When you see rate cuts there, fixed income benchmarks typically appreciate. That's due to that inverse relationship in between yields and bond prices. So typically speaking, rate cuts are going to be a tailwind for your fixed income space there. So that's kind of the fixed income side of things, mostly.
Yeah.
And then you can kind of jump on over into maybe something like domestic equities, for instance. Now, this is a little bit more of a mixed bag. And the reason for that is twofold, right? The reason primarily why you are cutting rates is because there might be some signs of economic weakening, right? So maybe the labor market isn't as strong or, the whatever it is. So you're cutting rates to kind of inject life into the markets, inject life into the economy there. And so if there actually is a need for economic stimulus and the economy kind of rolls over, that can typically be a pretty bad sign for markets. But of course, there's the other side to that where, you don't need, right, economic stimulus. You don't need, markets aren't weak. The economy isn't weak. And so the tailwind that's offered by your kind of lowering rates actually helps out the market. So you kind of get a little bit of a wider dispersion for domestic equities. I'm not here to make a call on whether I'm bull or bearish on this one. But that's kind of the typical history for domestic equities, right? You have there's a reason to cut rates, and that kind of shines through, or the economy stays pretty resilient and rates come down, and you get some of that tailwind from lower borrowing costs.
Right. And it's interesting though, because we'll just have to see where it goes. But the dilemma was it appears they thought maybe inflation is at a better place relative to where it was, and comfort, but also cutting rates. It's that juice, and it's sort of like, why do they feel this need? There's this major slowdown coming. What's going on? All that's still to be determined, but keep going. Yeah, it's just interesting time.
Oh yeah, there's a reason why they were raising rates, right? And because everything
Right.
I just said, the opposite is true when you're raising
Yep.
rates. So raising rates will typically suck some of the money out of the economy, right? Because you're typically paying a little bit more, so you're incentivized to maybe not borrow right now. You're incentivized to keep some money on the sidelines because the rates are higher, right?
Yeah.
So that way inflation cools. So the hot topic over the last year and a half has been inflation. Hence, you raise rates, you take some of that spending power out of the markets, inflation cools down. It's really just this play on the soft landing, right? And so now, just like you alluded to, what are we watching, right? That's going to be the labor market strength, really just signs that the economy is slowing, and that's going to be the name of the game. Of course, that drifts away from the pure technicals as of what I look at, but of course, to be a fan of the markets is to be a fan of the economy and also the fan of the fundamentals too. All of them play a unique point in the game, but yeah, there's plenty to unwrap there. But yeah, to that point, raising rates and lowering rates can impact different areas of the market pretty substantially. But for where we stand right now, I think it could go either way. That's a long
Right.
comment to say it could go either way.
No, absolutely. It could. We're, you would know, but sectors move, right? Like real estate's improved, or utilities, these things that are highly interest rate sensitive. So there's a lot of moving parts, and each time's a little bit different. But yeah, just curious, there's other asset class too. I guess gold has certainly been perking up quite a bit. So that seems to have an impact there with the interest rates. Or your thoughts?
Yeah, exactly. And that makes sense, right? And we have to think about why that makes sense. And I'll try to unpack it in a way that hopefully makes sense. When gold doesn't pay any dividends, right? And so what I like to think about gold is that there's an opportunity cost to holding it, right? Because if you're just holding physical gold bars in your safe at home, right, that's a defensive asset. It holds value, but you're not getting any dividends. You're not getting any yield on those gold bars, right? Or those gold coins, whatever it is. Now, when interest rates fall, right, the opportunity cost of owning gold goes down. Opportunity cost being, hey, I could let this sit in my safe, or I could go out and get X yield in the market. So that the difference between those two in terms of a value or monetary value falls. So that is typically a tailwind for gold. That portion, the opportunity cost differential, slides down. And then the second is going to be the fact that gold is typically an asset that is used in times of concern or perhaps recessionary fears. And so again, as I mentioned before, when you're cutting rates, you're typically injecting stimulus into the arm of the economy. So, they're doing that for a reason. And so you would pick up gold as a defensive asset in case you see that economy roll over. So yeah, lowering rates all in all is going to be a tailwind for gold and other precious metals. The same argument applies.
Okay. I mean, so suffice to say, they've just started this rate increasing cycle, and we're just going to have to see where it goes, and we're on that for sure. You're monitoring it. I don't know if you have any other thoughts. There's other issues going on too, and an election coming up, right? So
yeah. Who knows, right? Things could get a little bit bumpy, and there's a couple things that probably listeners or maybe the average Joe are pretty concerned about. One is the rate cuts, just like we just talked about for a bit. The second is going to be the election, right? And who's in charge of the economy, whatever it is, whether you're a Trump guy or a Kamala, there's opinions on what is going to be happening over the course of the next year. And people are shaping their thoughts about the markets and how they're approaching tax season and all that type of stuff based on who's in control. So there's a lot of stuff to say about the election for sure.
Yeah, there's a lot of commentary, and who knows, mid to late September, it appears to be kind of a coin toss. And, right. You could get into all the factors, but it is so unusual, not just the candidates, but I mean, you've had 2 assassinations attempts on a former president, another, a sitting president stepping aside. So it's just really interesting. But there's been issues in the past, right? Elections always stir up a lot of discussion, what ifs,
right.
et cetera. What does history show? One of the things we really stressed, or I stressed quite a bit in prior periods, we definitely saw a lot of folks very caught up and worried about it, and sort of, if this person's in office, or if that's, then I can't make money, or that's not going to be good. And, that may or may not be the case. In some cases, it ended up just costing them an awful lot of money. So right. I really like to rely on a system like yours and relative strength and what's actually happening versus this theoretical or commentary. And that's why I think it's so important to really have a barometer or a compass of measuring what changes are occurring. But tell me what some of the thoughts you have on it at this point, or what you're looking at.
Yeah, here's the one-liner, right? There are always going to be headlines, no matter what, whatever candidate wins, right? We're sitting here on the end of November, and we know, right, there's going to be bad headlines about the economy, no matter what, right? So having a system to kind of weed through all of that noise is really important. If you read and traded on every single bad headline about Trump or about Kamala, you would be trading probably every minute.
Right.
So having a way to kind of weed through that noise and say, all right, well, when does this stuff actually matter? That is an important process, or important part of every process, whether you're running your own portfolio or whether you're running it for somebody else. Having that is a big important key. Now, the comments about the historical levels for presidential elections and around that, I'm actually doing a piece on this in today's report. What it's turned out to be is that there really isn't. It's not a question of who is in office, right? If we're talking about pure Democrat or pure Republican, it's not really a question of who is in office, right? The market has had up and down years under each party, severe ones, I may add, severely positive, severely negative. But it's maybe more of a timing of when within a presidential cycle we sit. We have to think here about uncertainty, right? That's the main thing that's going to drive fear within markets, is not knowing what's next. Right. Markets can put up with Trump, they can put up with Kamala, right? But it's the uncertainty of not knowing that is a main concern. So I'll pause there, see if you've got any thoughts on that before I jump into the statistics.
The thoughts that come in are that all we really know is right now, markets are close to all-time highs in a lot of cases. So, and it is parsing or interpreting all this information at all, it's an open source system. So what is it's looking at everything from tax policy differences to what's going to be, it's really interpreting everything, what's their geopolitical, acumen? Can they deal with this stuff?
Yep.
All those are current, they presumably priced in until there's new information. So it's holding up
Correct.
okay. And so, I always watch a lot of our processes talking to folks. It's not that we ignore, we call ourselves kind of the noise canceling headphones because there's so much worry about things, but I'm always looking at what are markets actually doing, the interest rate change, or if there was a Monday a couple weeks ago where there's another attempt on Trump, right? At a golf course. Okay, what did the market do? What did gold do? What did oil do? What did the US dollar do? Those are things
all
we
these
look
things are
at.
playing a pretty big game of telephone, right?
Yeah.
Everything's kind of communicating.
In reality, it didn't do much. It kind of just kept moving on. So,
right.
The NVIDIAs of the world, it didn't really impact their earnings. I'm not saying these issues matter, but the market as a collective, you have your finger on the pulse of actual supply and demand in that. And that's pretty darn important for filtering out noise, and especially in kind of emotionally charged situations where people are going to have strong feelings one way or another. So that's how it came to my mind. So
yeah, no, you get at a really important part. Like no matter who wins this November, all of us are going to be playing the same game, right? All of us are playing the same game of trying to find stocks or funds or asset classes that are going up. And so, finding a way to, look kind of through the looking glass, if you will, and find those with a systematic way can have some pay dividends, quite literally. To kind of wrap up on that previous point about historical election tendencies, like I mentioned before, it's not about who, but maybe when within a presidential cycle. So you see some historically maybe more poor years, I'll say. On the second year, you have midterm elections of a presidential election cycle there. And so there's some uncertainty, like I mentioned before, kind of creeping in. So the second year is typically the worst. Then you've got like kind of the first and third years of presidential cycles. Those are going to be, or presidential terms, those are going to be maybe more average. And then the fourth year is actually the best typically. So, that's kind of what you get when you're looking at this. And then furthermore, maybe a more of a near-term comment for 2024, the fourth quarter of the last term, or the last year of the term. This is a lot of jargon here. The fourth quarter of the last year of the term in an election year is actually stoutly positive. Again, that's because the markets know who the winner is, and they're kind of digesting that and going through. There's no uncertainty. We know who the winner is and can kind of go from there. So hopefully that provides a bit more color. There's ammo. There's a fair shot markets go up no matter who wins, right?
Right. Hey, shifting a little bit, but these are other topics.
Yeah.
You and your team, you've done a lot of work on what they call market seasonality, correct? Like a strong 6 months and a week. And do you want to comment on that and what that's, I know different years are different, but there's some pretty strong themes and trends if one looks at a lot of data. And we're in September, right? We're approaching the end of one period and entering another. So why don't you cover that a little bit?
Yeah, there's a whole saying, sell in May, go away, come back later on in November. We're sitting at near the end of what's historically the worst month for markets. September is historically one of the worst months of the year. Now, barring anything crazy happening towards the end of the month, that probably isn't going to be the case this month, right? We've kind of bucked that trend a little bit, which is nice to see. But you're moving into a month of October where you see some pretty big swings. We have this piece we put together called the love-hate October. Markets have this relationship where you're either pretty positive, or of course you have some pretty major sell-offs. I don't think I have to name them, but you have some pretty major sell-offs happening in October as well. And then November, December, kind of wrapping up the year. Everyone's buying Christmas presents. My birthday is in December too, so that's always nice. But yeah, towards November and December, you get the kind of seasonally strong parts of the year really taking place. And then that kind of persists through the first quarter of next year as well.
Yeah, so I've become highly aware of it. It's just another factor we consider, right? Maybe having a wind at your back or in your face, amongst other things, right? Yeah, so we're getting through it and we're starting to enter the stronger phase. And we'll be there maybe by the time this releases.
It's all about putting the chips on your side, right? It's all
Right.
about putting as much of a probability as you can to make a proper trade, to make a proper read on the market. So all of this is kind of coming into play. The election side of things, the rate cuts,
Yeah.
the seasonality. Of course, then you've got individual pictures of relative strength as well. But you kind of put all those together. Nothing, of course, is a silver bullet, but you can, like I mentioned, hopefully sway those odds in your favor as you're going through and making decisions.
Yeah, 100%. So I look at a lot of this data and the only source, but the relative strength is awfully important. And again, it's an important input with other stuff, fundamental and all kinds of processes that, we're just trying to stack the probabilities in folks' favor of making good decisions.
Right.
I'm a tennis player. I've been listening to a number of podcasts from experts and coaches. One of the things that's really, really interesting, if anybody plays tennis out there, is these winning players. To be a winning player, and I don't know if this applies to markets, but you lose a lot of points. You might need to win like 50.5 or 51% of the points. And even guys like Roger Federer won, they lost a lot, maybe 48% of the points or games, but they still were enormously successful. If you can stack more in your favor. At any rate, that's just something that occurred to me because I play tennis, but I was really shocked to learn that because every point you lose, you feel so frustrated, but you can lose an awful lot as long as you manage to win a few more than you lose and still have enormous success. So don't know if that, yeah.
No, and that kind of brings up another point too. You also have to get streaky at the right time, right? I mean,
Yeah.
you can in investing and in momentum, I think about it like this, right? Momentum is widely known for letting its winners run, right? So I think about it like that. You go on these streaks where, you do lose some points in there. Don't get me wrong, right? But I'm sure on his way, I don't know all the tennis lingo, forgive me, right? But on his way to his multiple championships, Federer went on a number of important streaks. There were a lot of NVIDIAs in his portfolio at the right time to make him so successful. So that's kind of maybe a play off your thought.
100%. And then, to your point too, hanging on to those winners is just absolutely giant. People who, they want to get out of those while they're still in this position of running or strength, so seeing these nuances, if something is not working, getting out or stepping away from that may change at some later date. But most of the time, if they're not working, they're going to kind of stay out of favor in that momentum unless something dramatically changes. And we might not want to get involved with that or own that until that trend does change or we see clear evidence of it, right? And that's a lot of what your system and work and processes, that's a big part of what you guys do, correct?
Yeah, exactly. I think about it like this. If you're taking a test, there are some tests where you are penalized for not trying, and there's some, or not answering a question, and there's some tests where you aren't. Right. And investing is pretty similar to the one where you're not penalized for making the wrong choice. Now, I say that with a couple caveats because I think you could say, well, Miles, yes, you are. If you throw it all into a stock and it gets obliterated, then you would be kind of out of luck. Right. And that makes sense. But to my point that I'm trying to make is you can sit on the sidelines and wait for that proper trend. You don't have to go, and answer every single question if you don't want. You don't have to go and follow every trend. You don't have to go hop on every single crazy GameStop swing or something like that. You can find the right opportunities and you're not penalized for waiting until you get that right opportunity. I think that hopefully that makes sense to some of you out there.
Yeah, it does. Boy, I did have someone who sort of wanted to get GameStop recently, which was really a surprise because we're managing everything. And I just sort of talked him out what a terrible idea that would probably be, how it's not really trading on fundamentals. It's more of a timing thing, but
right.
That's beside the point. What else? We're going to start to kind of wrap up because we'd love to have you back because you're so engaged in this. And there's a lot we interact on. What else are you, any other thoughts that are jumping at you at this time, or things you kind of like to share or impart, or anything like
Yeah,
that?
one thing I've really been watching, and then we can kind of wrap up with maybe a last technical comment and something I'm
Yeah.
watching in the markets is really just the participation that's broadening out. Throughout 2023, we saw just pretty much seven, at sometimes six, sans Tesla, leading the market higher. Throughout the last couple months, that's really shifted. Equal weighted indices have certainly done their fair share. That's certainly not to say that the cap weighted stuff isn't strong still,
Hmm.
but we're seeing a nice broadening out of participation, which I think is leading and building a really strong foundation up into to the fourth quarter. So that's really what I'm watching. Of course, we've got a bunch of different indicators and things like that are helping me read those participation readings and indicators. I won't get into all of them today. I'd be happy to do that on another podcast.
Yeah.
But that's what I'm really watching as we wrap up the year.
Yeah, I think that's a really great comment, because I've commented on that a lot. And I recall we were seeing some broadening out, and then all of a sudden some things got interrupted there for a little while with some pickup in volatility. But it was pretty unhealthy to see so much of the dominance of the gains in, like, they talk about the Magnificent Seven, but really only five stocks. If there's only
Right.
five people or companies participating, that's concerning. And so you are seeing a broadening out, is what you're saying. That's appears to be
Yeah,
going
exactly.
on.
I mean, I
Okay.
think about it like a battle, right? And I'll
Yeah.
close on this comment because I know I'm rambling on, but
No, you're not.
you have think about a battle, right? I'm making my way through Game of Thrones right now, and I'm sure it's leading up to some big fight, right? But if you just had one general at the top, right? If you just had Nvidia, if you just had Meta, and there were no soldiers behind the general, he would die on the battlefield, right? And so you can have these super strong players at the front of the battlefield, but ultimately, if there's nobody behind them, eventually they will fall, right? No matter how strong they are. So, seeing more soldiers join the generals behind them, the odds start to stack in your favor, like we talked about before. So, yeah, that's kind of the analogy I would use for that, and it's nothing but a positive to see more stocks moving up.
Yeah, I love it. That's a great analogy. I know that's something you refer to often. Yeah, we'll kind of land the plane. I'd love to have you back. I will just slide this one. Are there any books you're reading right now that are really interesting, or anything I like to ask that of a lot of my guests. Just curious if there's anything. Could be on the markets or anything. Yeah.
Currently, I'm moving through level 2 of my CFA material.
Okay.
So that I would consider some books. Maybe it's not as fun as some of the other books. I just wrapped up Just Keep Buying, and then Same as Ever has kind of been my at night read. But I haven't made my way completely through that one just because I'm learning all about the economic indicator stuff we're talking about today over in the level 2 stuff.
Yeah, I get it. Yeah, no, I've had times where I've been incredibly consumed by that kind of material and didn't have time to broaden out, but I just thought I'd throw it out there. You'll get back to the other. So, hey, Miles, we'll do this again. I really value having you on as a resource. I hope this has been helpful to folks. We've got some really great guests coming up in the future, and we'll have you back, Miles, and we'll keep exploring what's going on, try and be of value to people. If you like the podcast, please share it with folks. Feel free to like it, but we thank you, and thanks to make it a great day, Miles, and thanks for being here.
Yeah, of course. I had a lot of pleasure being here, and I look forward to coming back on another week.
Perfect. We'll do it. Take care, everyone.
Bye-bye.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors. Signature Estate and Investment Advisors, LLC, SEIA, is an SEC registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities, LLC, member FINRA SIPC. Investment advisory services offered through SEIA, LLC. 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.